This is the current federal tax developments for the week of April the 18th, 2016. Current federal tax developments are brought to you by Nichols CPA Incorporated and your state society of CPAs. This week, we're going to look at a few issues. Some of the highlights this week, we're going to get inflation adjusted numbers for the Affordable Care Act individual numbers for 2017 and information on aircraft for the first half of this year. We're also going to get some guidance from the IRS in regard to a couple of congressional letters about how to properly calculate your HSA contributions if your client qualifies and enrolls in Medicare, including the more complex situation where both spouses attain age 65 during the year, but they enroll in different months. We'll also look at that why going with the K1, going without the K1 to finalize a return, as some people probably going to be pushing you to do or have been pushing you to do last week, turned out to be a problem for a taxpayer. And finally, back to the future. DHL reappears on the list of approved private delivery services for the IRS. As I noted, current federal tax developments are brought to you by Nichols CPA Incorporated and your state society. And as we go for this fun week of tax developments, we'll take a look at what's been going up and what's happening. Now, of course, the big thing coming up right now is, as you probably all are aware, this is the week of the 18th, and this is being released just before that date. But the 18th is a special day this year. This year, the 18th is tax day. And so hopefully you guys actually waited a little while before tuning in on this. If you're actually listening to this on Tuesday, the 19th, just stop right now and go do something, that's non-tax related for a while. But it is tax day, the 18th being tax day for those of you who are not aware as to the reason why, and I'm sure most of you are, but the issue is that we have holidays in District of Columbia determine what the tax day will be. The 15th, which was Friday, was a holiday in the District of Columbia because the 16th, which was Emancipation Day in the which is Emancipation Day in the District of Columbia, fell on Saturday. That moved that holiday back to Friday. That means that therefore the first filing date, since Friday was a quote holiday, becomes Monday, the 18th. We're going to have issues with the interaction with Emancipation Day for the next couple of years with tax day. But the big issue is that come Tuesday, for those of you, hey, it's party time. CPA's time to party on. Basically, the tax season has ended. Now we know we've got you all those extensions and the other pieces of fun, but at least you got a little bit of a break. I'm going to remind you that the State Society catalogs for many of you will be arriving. And don't forget to go ahead and take a look in there. Take a look, find the courses we're going to start presenting. I'm actually going to be presenting the week following the next week. Actually, I'm going to have my first session I'll do I guess it's the last session of the old year, but I'll consider it for all practical purposes the first session of the new year. And then I'll be doing some courses in May in Washington and Oregon. So we have some interesting things to go on. My course actually in a week will be here in Arizona. So we're going to be looking at a lot of courses. The State Society courses will come out. It is that time of year to start planning your continuing education. So you want to go ahead, be sure to take a look at it, consider the course offerings that your state societies offer, both those that are offered from Nichols Patrick that we give you options that we are going to be presenting, as well as those presented by the others there for your state society. But now let's go ahead and take a look at what came up this week in terms of our developments. And we're going to start out with inflation adjusted issues because, hey, we index things these days, so we have to get new inflation adjusted numbers. And the Affordable Care Act is another area where Congress put in some inflation adjusted rules that requires publications. In Revenue Procedure 2016-24, issued on April the 11th, the IRS put out the inflation adjusted individual affordable care percentages for a large purpose. That'll be effective in 2017, so we're a little bit ahead of the curve here. The major thing that comes out is the table of percentages for those who are going to qualify for the credit. Individuals who obtain their insurance from an exchange, who otherwise do not have affordable employer-provided insurance, the credit is computed using a percentage that is published in the table. The table has now been updated. This credit that we have available for us, the applicable percentage table for the credit being under Section 36B, it runs for individuals whose household income runs from 133% of the poverty level all the way to 400% of the poverty level. The percentage numbers will range from 2.04% up to 9.69%. That is the percentage of household income an individual is supposed to contribute towards providing health care, and specifically towards paying for the second lowest cost silver policy available in the particular area, state, whatever locality they're in. That percentage times their household income tells you their contribution. If the cost of the second lowest cost silver policy is more than that, then they potentially qualify for a credit of the lesser of that difference between the silver policy, the second lowest cost silver policy, and their percentage contribution, or the premium that they actually paid for the insurance if they buy insurance that's less expensive than the second lowest cost silver. Again, these numbers will run. Now, as I mentioned, affordable employer coverage is set to 9.69% for testing for the credit. That was the number at the top of that range. You may have remembered 9.69% is your testing for do you have available affordable employer provided coverage. And the unaffordable coverage for exempting somebody from having to pay the cost for having basically not having medical insurance. Remember that's your penalty for not having the insurance, your shared responsibility payment. That particular payment is set at 8.16% for 2017. So again, we have a couple of key issues here looking at our percentages for 17. Now, again, that's not 16. This is actually going all the way forward into next year. Obviously, the 16 numbers were important for planning for 16 and getting coverage. The numbers for 17 come out early for the same reason. Now, a number that does have a current impact that was issued in Revenue Ruling 2016-10, which was issued on the 8th of April, is the rates for the SIFL, basically flight rates, for the first half of 2016 are issued by the IRS. These rates are the ones used for valuing the use of employer-provided aircraft. And this applies for the 6 months. So this is for flights taken by an employee that are non-business, so we're going to put the personal part from January 1st of 2016 through June 30th. And you compute it using a terminal charge and a mileage number if you elect to use this method. The terminal charge for the first 6 months will be $39.19. And the mileage rate depends upon how far the travel was. Up to 500 miles, the rate is 21.44 cents per mile. From 501 miles to 1,500 miles, it's 16.35 cents per mile. And for 1,500 or more miles, we end up with 15.72 cents per mile. Again, this is the amount put into the employee's W-2. Don't forget that due to the special rules that limit the deduction to the employer for certain control employees, your actual cost of providing that air flight will have to be reduced to that amount put in the W-2 if you have certain officers, owners, other control employees under the special rules. But the civil numbers, if you're using those numbers, they are now out and published. Next up, now we get to a couple of information letters. The IRS this week, in response to congressional inquiries in the area, or basically on March the 25th, issued a pair of letters which are kind of interesting because they help explain how to handle this. Health savings accounts. You may remember that you can put money into your health savings account up to the maximum each year, as long as you're only covered by a high deductible health care plan. However, the law specifically states that once you have enrolled in Medicare, you can no longer make a contribution to a health savings account. Now, the problem becomes, obviously, people don't enter Medicare necessarily on January 1st of a year. They'll enter it on a different date. They may enter it when they turn 65. They may enter Medicare later if they continue to work for an employer, they have other qualifying coverage that's quote unquote equivalent to Medicare. And remember, under the HSA rule, it is merely you have to actually enroll in Medicare for the limitation to kick in. But we have a pair of letters here, and they're information letters 2016-0014 and 2016-0003. They explain two different cases. The first one's pretty easy. It talks about a single individual with single coverage who had no disqualifying coverage during 2016 and entered Medicare on October 1st. Not surprisingly, she's allowed to put into the account an amount equivalent to 9/12, 3/4 of the limitation for the year 2016. That's not the one probably anybody having difficulty with. The more interesting one was the other letter. And the second letter talked to us about what happens under letter 2016-003 when you have a spouse. We have basically one spouse had family coverage entering the year, the other spouse enrolls in Medicare on May 1st, and then the spouse who had the qualifying coverage enrolls in Medicare on October 1st. So think of it this way. We have spouse John and Mary. Mary has family coverage. John attained 65 prior to Mary. John enrolls in Medicare on May 1st. Mary doesn't attain 65 till later in the year. She enrolls on October 1st. In that case, the IRS said, here's what you have. You have 4 months, essentially. You have family HDHP coverage. So for 4 months, there's family coverage, and you have a 4 months of your maximum contribution is based on the family coverage limitations. And essentially, then when we go on the following months, so that we go from April through September, those months you're going to be limited to the single contributions, plus you have the potential catch-up contributions to get involved. They walk you through the math of situations like that. That second case is a much more interesting one. Again, that is letter 2016-003. Next up, this is something I think all of us have had clients want us to do from times, and you've probably been hearing this for the past week or so. Some clients just hate to file an extension. So we have Lamas Ritchie versus Commissioner, Tax Court Memorandum Decision 2016-63, issued on April the 11th. In this particular case, the taxpayer in this case became a member of a partnership that took over a website he established that became very successful. And this company, he gets involved with another gentleman, enters into a partnership. Now, this other gentleman who has other activities, he hires Nick to basically be an employee, and he continues to edit the website that he's a partner in. He edits the website, receives W-2 income. The partnership operates for a number of years and never shows income. Now, Nick's coming up on April 15th of 2012. He wants to file his 2011 return. So he basically gets his 2011 return. He has the W-2. He received no distributions from the partnership during the year, and the partnership had never shown income. Nick apparently informed his preparer about this. We'll get to that discussion here in just a second. And they prepared the return and filed the return, not showing any income from the partnership. The partnership finally filed its return on the last day it could in September. And the K-1 for Nick showed over $21,000 of income. Now, Nick never received that K-1. Nick's first knowledge that there was such a K-1 occurred when his return was examined for 2011. Now Nick was clearly aware he was a partner, but Nick, had said, well, it always lost money. Couple of problems you've got here. Number one, not surprising at all to anybody should be, that Nick still had to report the income. The fact he didn't get any money is irrelevant. The fact that he later gave up the interest a couple of years later, because it turns out his website is a gossip website that you may have heard of. And it turns out that running a gossip website can get one sued, depending upon what you're publishing. So for various reasons, Nick decided to abandon, unspecified reasons as to why he abandoned, but presumably the lawsuits kind of were part of the deal, why he did that. He still edits the site. He was still employed to do that. But he never got cash from the site. He still had to pick up that income. That's not relevant. He said, but I had losses in the earlier years. Well, the court said, you presented us with no evidence of what those losses were, or if they survived, or if they're somehow available to be used against the income this year. So he said, because of that, tough luck. Now, the court did give him a bit of a break here, though. They did not impose penalties. He was aware he was a partner, and therefore he should have been aware that, he had income coming. But because he had used a paid preparer, and because the preparer was aware of all the relevant facts, and the preparer gave him assurance that his return was correct when he prepared it in April, Nick was let out of the penalty. Now, what we don't find out, because it's not relevant to Nick, is whether the preparer may have an exposure here now if the IRS wants to move against the preparer under preparer penalty rules, because obviously, the flip side of that is, the preparer, if Nick's not held responsible for waiting for the K-1, could the preparer be held responsible? He's kind of iffy, but it's kind of one of those tough issues. But honestly, yeah, it seems like the preparer may have an issue here. Other issue that we got involved here is the problem of going without the K-1s. Again, the case doesn't deal with those prior loss years and whether Nick reported the losses or not. But unfortunately, sometimes it seems like if Nick was used to filing without the information and he didn't worry about it because it lost money, it seems conceivable that Nick might not have ever put the losses on his return and claimed them either. That's the other big risk of going without. Now, again, the IRS is not going to examine you and force you to report losses in those years you had losses, but they are going to they do pick up the income. So again, it's always dangerous, and you've got to persuade clients that there is a reason why you want to wait for the K-1s. My answer is pretty simple. I didn't buy the partnership. I didn't enter into the partnership. You did. The problem is yours, essentially. I'm just the messenger, and if you don't want this problem, then you need to get out of the partnerships. Finally, for this week, we have the Back to the Future time. Notice 2016-30. You may remember that last year, the IRS put out a new list of private delivery services. And the interesting part in that notice that came out, notice 2015-38 last year, that came out just about a year ago, the IRS had updated its list of approved services, and one of the services that disappeared was DHL. Now, DHL doesn't operate generally inside the U.S. for deliveries inside from U.S. to U.S., but it still operates for international deliveries in the U.S., and in fact, it's much larger there in Europe, etc. So DHL got itself back on the list. So specific DHL services appeared on the list for using for the equivalent of the timely mailing equals timely filing rule. Again, as before, please remember, it is not just that you use a service from UPS, FedEx, or DHL, because those are the three approved vendors. That's not good enough to get the proof. You must use one of the specific services listed in Notice 2016-30. So, for instance, you can't use a service that's not on the list. Let's take something like from FedEx. If we took a look like Federal Express, FedEx 3-day service is not, or I should say FedEx Express Saver service is not on the list. You can use FedEx 2-day service because that is on the list, but you can't just use a FedEx service. We actually had prior to the last one coming out, the last update coming out last year, FedEx had added a brand new first thing in the morning overnight service. And the problem was that wasn't on the list prior to a year ago. That didn't count either. If your client wants to use one of these services to file the return, not go to the post office and use certified mail, they need to be told that they have to take a specific service off this list, give them the list in Notice 2016-30, and tell them specifically they have to use that service. Secondly, make sure you tell them that they have to get evidence of it entering their system. As the IRS warned you a year ago, that evidence will not necessarily be preserved forever by the vendor. You need to get the evidence and show it going into their system. Quite often you can get it from the website or by getting a printout from the company, but you need to do that essentially, let's say maybe a couple of days after you sent the package so that you get the information to prove your postmark date. It's very important if you're using those to actually get the proof of the date in order to support your claim that you actually filed this stuff, because that's somewhat important for this situation. This has been the current federal tax developments here for the week of April the 18th, 2016. Now, again, as always, information, links, and write-ups on these are available on our website at currentfederaltaxdevelopments.com. We will also have uploaded here shortly a copy of a PDF with a description of all of the issues we discussed about this week. And we'll give you updates during next week, I should say the week of the 18th, as things begin happening in taxes. So we'll take a look at some of the developments, and I'll have a little more time to go look at things. So I'll probably catch up on a couple of things that have happened that I didn't have time to cover this week. Remember to check your state society catalogs that are coming to you. Make sure to consider, when you consider continuing education, be sure to consider your society's live courses and consider those that we're offering you here at Nichols Patrick CPE. And be sure to see us. That we'll come back next week and we'll talk to you about what's been happening in the area of taxes after tax day. And we'll see you then.